Commercial real estate is killing the small and regional banks in the United States. Welcome to the Best of U.S. Investors weekly review, where we take a look at what happened in markets, what is pressing, and what was heavily talked about during our calls on Friday with the Platinum Channel and Carrie's call at 3 o'clock Central. Today I am shooting this from my wife's studio, a commercial warehouse real estate thing, and that is becoming one of the biggest burdens on the small and regional banks in the United States. It's actually talked about that we may just see a roll-up of all the small and mid-sized banks and cut the number of banks in the United States in half. Click, gone, right? Well, that means a lot of issues when it comes to stock market and all this. This week, we're going to hit upon those items and how to have a trading plan and the repercussions of not following your trading plan. And we're going to talk a little bit about how to protect your 401k, Roth 401k, and retirement plan. So let's get to it. The small and regional bank sector has been under pressure. We saw it with Silicon Valley Bank last year. We saw it with Signature Bank and a handful of others. Well, this past week, we had another regional bank failure or crushing that rolled out, and it has brought up a lot of attention about what pressure these small and regional banks are under. And in this next section, Mark touches on that, along with Carrie, and some intake or outtake on what they feel like is coming down the road.
Regional banks got another hit this week, basically when New York Community Bank Corp came out and cut their dividend. And you saw that because they have a lot of commercial real estate on their books. So we'll see what happens there. And on the other side, JP Morgan's out saying that they're going to open up 500 new locations by 2027. So maybe they think 500 little regional banks are going to close and they're going to buy them for pennies on the dollar. So
that's exactly what I thought, Mark. They're just going to come in and change the label on the front of the building.
Yeah. So, I mean, they're not dumb. And if you just kind of look at the big picture, you can kind of connect dots, and I don't know, call it conspiracy theory or not, but it just seems strange to me, Carrie, that all happened in the same week.
Yeah, I think, quite honestly, I did a video where I showed the players in the subprime crisis and then the Janet Yellen and whose name am I trying? Powell. And then Jamie Dimon. I think they had the too big to fail weekend meeting last week, and Jamie said, "Yeah, I'll buy up all your little regional banks that are going to fail for 30 cents on the dollar, and I'll go in and put my label on them, and away we'll go." Yeah. So
yeah, and I think Janet came out and she said something about there could be trouble in the regional bank area, which is unusual for her to have anything negative to say. So yeah, you never know.
Last Sunday, there was a 60 Minutes interview with Chairman Powell about the Federal Reserve, interest rates, and all that. And Mark talks about in this next section how not following his trading plan, that event that he knew nothing about that was going to happen, actually hurt him because he didn't follow his trading plan. Now, if you don't have a trading plan or investment plan, chances are your financial advisor doesn't have one either. And they probably know they just buy and hold 60-40. Well, the world has changed, folks. Get on board and get noticing. In this excerpt, Mark talks about how he didn't follow his trading plan and he took a hit because of it.
TLT obviously is inversely related to interest rates and treasury yields. So when this week, and I made a mistake that I didn't follow my trading plan and got out of the stocks last Friday, and I had TLT. And then an unknown market condition to me was that Powell got on 60 Minutes, okay, and talked about the market, and The next day, the Treasury yields, because they weren't going to raise rates, the Treasury yields went up, causing TNT to come down. So that and all week the yields have been up, and it's been really strange because today they were up and the markets were up, which is normally the opposite. When you have a 10-year go up, the markets usually go down. So it's a strange market. So I got out of TLT with a small bit of a loss on Monday, and it's still down today. And we can take a look at it.
I read a story saying that some of the smaller banks are offering up to 12% on a 1-year note. I don't know if it's true or not, but I read this today. I almost fell off my chair.
You mean a
Small
CD?
banks are.
Yeah, CD.
Huh.
I would be wary of getting. I haven't seen that yet. I mean, I watch those markets pretty good, but I'd be wary of getting into that at this point on these small banks. But I understand why they would be doing it. But 12%, wow.
Yeah, up to 12% for 12 months.
Okay, that was good. I'm happy.
So yeah, I was looking at yields. I bought some 2 and 1 month Treasury bills, and they were around 5.35, 5.36 this week, just on Treasury yields. But here's your TLT, and you can see it was doing a nice trend up. And 1, 2, 3, 4, 5, and this was last Friday. I thought, well, it's just bouncing off the 200, and I should have got out at that point because here's where my entry point was, and I didn't. And then Powell spoke, and then boom, and then we just went, and we're still down, just about coming up to the intermediate support level. So we'll see what happens next week. But yeah, that pretty much fell apart. And thank you, Jerome Powell, for helping me out on that one, and thank me for not following my trading plan and not getting out like I should. And that's what happens when you don't, and you let emotions get involved. Sometimes your trades don't go the way you want.
On the Discord, Gene reached out to me and said, hey, would you mind talking about, in light of this whole credit crisis in commercial real estate, small and regional banks that we're seeing, how do I protect my 401k, my retirement plans, and how should I allocate to prevent losing my shirt? So I talk a little bit about that and the phenomenon happening between the relationship of bonds and equities and how all of a sudden they become buddy-buddy.
Cool. So I got a message on the Discord to in regard, it was from Gene, and he said, could you talk a little bit on the call about what you last week we talked about bonds and what they were indicating, this sort of credit crisis that we could be having in commercial real estate with small and mid-sized banks. He said, what do I do with my 401k, my Roth 401k, those your retirement accounts? And so something I wanted to give you just sort of an idea of what we're looking at with this. This is, let me know when you guys can see this.
It's there.
Yeah.
Okay. So this is a 3-year rolling average of what the relationship between bonds and stocks, in particular, the aggregate bond index, which most people have a mutual fund or index fund labeled aggregate or Lehman Brothers aggregate bond index in their 401k, and the relationship to the S&P 500. And as when I started in the financial planning industry back in 2000, we were taught that that bonds were oppositely correlated to equities. So it would have a if the S&P had was 1, bonds were a -1. So if equities went up, bonds went down, and vice versa, and you would create a portfolio based on the person's risk tolerance. Well, as you can see in this chart, that opposite correlation that we have sort of adopted over the last 32 years or so is actually now changed pretty drastically. Today, bonds are about a -32% or so correlated to equities. So most people run a risk model in there, or they use a target date fund in their in their portfolio, in their 401k or Roth 401k, and they'll say it's a 60-40 split. Well, that 40% of bonds is no longer oppositely correlated. It is less correlated now. And this chart here takes you to the end of the 2023. So what we're seeing is what we used to think as risk-off assets in bonds here in the last, say, 6 months or so is now becoming more riskier as we go forward. And so when Gene asked, what do you do in your 401k to reduce this risk now that even bonds are now becoming riskier, in particular high yield bonds, the answer is cash. It's a money market account, because majority of money market accounts will stick pegged to the US dollar. Until we see that correlation go back opposite of what it is today, we should expect continued volatility in the bond market. I'll show you a couple pictures of the where is it? Bear with me. Of the different so this is the volatility index for bonds, in particular US Treasuries. And as you can see, it's pretty much been going sideways for a while. We had a big spike in bond volatility back in March of 23. That was during the whole bank issues with Signature and Silicon Valley Bank. It's then mellowed out down in this area, in this channel here. And to me, this is sort of you got to keep an eye on this. Once we see a break over 120 on the MOVE index, which is the volatility index, we're going to see bonds get really hyped up. So if I'm looking at, for instance, I was talking about the Lehman Brothers aggregate bond index. This is actually the iShares ETF. You're starting to see the value of the bonds go down as the yields go up. So we're seeing less money flowing into bonds, and it's probably chasing Nvidia or some version of it. But at some point, this will become your defense mechanism, most likely. You also probably have a high yield bond option in your 401k or your Roth. And what you notice here is high yield bonds are performing close to what the S&P 500 is doing since November. So you probably don't want to be allocating towards high yield bonds because they're higher risk, and there's more potential for a blow up in those. What I sort of am gravitating to, and what I prefer, and I think a handful of some of the other smart money bond gurus of the world, is more of the short-term duration bonds. So putting a combination of cash and short duration bonds within your 401k or Roth could be a good defense mechanism. But take into account what I said earlier, and that is the correlation between bonds in the market in general have gotten much more closer in correlation to equities, in particular the S&P 500. And when you buy bonds, you want the opposite. So cash is king, in my opinion, until the bond market resets and the equity markets reset to where they're oppositely correlated and they perform like that. So to Gene's question, I would suggest look at your allocation, look at if you're running a moderate allocation, 60-40 split, take into account that correlation between bonds and equities has gotten closer. It could be much more dangerous in the future as we go through this weird time in the equity market.
This week I watched Nvidia just go like this. On Friday, I watched it go up like $25 in a matter of hours. Nvidia is on fire. It is if you'll look at a daily chart of it, it is a vertical move to the sky. Unfortunately, there's a thing called gravity, and that is giving signs of many other of the top, Magnificent Seven, which is really actually markets are being driven by the Magnificent Four now. The question is, what is to come in the near future? Is this going to continue? Is this a pretend and extend kind of event? Are we going to pretend the economy's doing well? We're going to pretend there's no commercial real estate issues? Are we going to pretend there's a small and regional bank, they're all glory and everything's wonderful? Or are we going to start looking at the reality? Well, chances are, in my opinion, we're going to actually see a continuation of pretend and extend for a while. So you can't fight markets because it'll bleed you out, because they're bigger and stronger, and there's somebody on the other side of you who has more money than you do. And I know some of you have a lot of money, but when you're swinging trillions of dollars, there's not a lot of people who can do that. So what do? You need to take action, you need to learn, you need to engage, and you need to be proactive about protecting your wealth. Join Best of US Investors, subscribe to our Platinum channel. We have a special going on for 50% off the monthly rate for 3 months. At the end of 3 months, it goes to $60 a month. It is an awesome deal. You're getting a whole lot of different stuff in it. So subscribe, look at the description below, and take us up on our discount offer and give us a try. In the meantime, have a great day, and always, always live loud.